Good morning. Thanks so much for tuning in. This is Buy Now, Sell Now on ET Now. My name is Alex Matthew. With me is Cheryl D'Souza. Good morning to you, Cheryl, as well as to everybody tuning in. Let's take a check of how the markets are faring today. And we began very well with the Nifty 50 starting off at a new all-time high. But since then, we've given up a bit of ground. In fact, from the high point of close to 15,629, we're currently trading just about flat. In fact, we're flitting between gains and losses at this point. You have the Sensex that is still defending the green in green territory, but just by a little bit. It's changed over the last half an hour or so, and you've seen that the market breadth has actually shifted overall in favor of the declines over the past half an hour or so. Let's take a closer look at the Nifty 50. You have just about even Stevens at this point, advances gaining. Reliance Industries is continuing to gain 0.7% as we speak, and that is lending quite a lot of support to the benchmark index at this juncture. The biggest losers are the metals counters that were the stars of yesterday's show, and a factor that you have to watch out for is the fact that India VIX is comfortably under 17, which broadly is indicative of supporting the bullish trend that you've seen over the last 7 sessions or so. If we manage to end in the green today, it would be the 8th consecutive day of gains, but perhaps just a tad bit of fatigue being seen on account of the rally that we've seen over the last several sessions. Not necessarily related, but you also had the high frequency indicator that came in about half an hour back. The India manufacturing PMI came in at 50.8, which showcases a bit of slowdown or a significant loss of momentum from the previous month. The reading in the month of April was 55.5. Cheryl, what are the stocks that you're looking at?
Good morning, Alex, and a brand new month, that is the month of June, is that what we've entered into. Also, it being the 1st of June, by tradition, we have the auto sales that come in for the month gone by. So you have Bajaj Auto as well as, of course, they've come out with their May sales figures. We are waiting for the rest of the auto companies to come out with their numbers as well. A lot of companies are buzzing on back of their earnings report. Also, you will have ITC that is all set to report its Q4 earnings later today, so all eyes on that as well. But there's one stock in particular that is buzzing in today's trading session, and that is Max Healthcare, and that is back on their earnings. But my colleague Pankaj Podar actually caught up with the management of Max Healthcare. There's Max Healthcare's chairman and MD Abhay Soy, as they spoke about the quarter gone by and also what's expected going ahead for the company. So take a look at a slice of that conversation.
There is a life cycle to the virus. After 20-25 days of getting infected, it's the people who've stayed in hospitals longer, perhaps on ventilators, etc. You're going to see some fatalities over there. This time around, what we are also seeing is a lot of post-COVID complications. So a lot of patients seem to be coming back with complications post-COVID because the lungs have been infected and so on. So yes, I think we are largely out of the woods as far as new admissions and new patients are concerned. But with respect to existing ones, there is we still have some time to go before we end this particular course.
Probably the key to fighting this pandemic. On May 1st, there were a lot of changes that were made by the government for the vaccination. However, one would say that implementation, availability of vaccine, overall, what's happening in the space is quite difficult. One would say, or implementation or execution has not been that great. But do you see things slowly and steadily picking up?
Absolutely. I think the challenge largely has been availability of vaccines. Both in public hospitals as well as private hospitals. This, I believe, has been easing up over the course of the last 1 month, and we are expecting a rapid improvement through June and July thereafter, because the supply seems to be coming through now. So I think by middle of June, you'll see a dramatic change as far as vaccinations are concerned.
You managed to raise equity, which led to payment of debt. Margins actually improved, average revenue improved. Can you just sum up Q4 for us, especially on the COVID side and the non-COVID sides of the business?
So Q4 was perhaps one quarter where we had the least amount of COVID vis-a-vis Q3, where we had 800 plus patients in COVID. The number had come down to about 200. We saw a return towards normalcy as far as non-COVID business is concerned, and that business was enjoying a very high level of occupancy. Having said that, the international business still hadn't come back in Q4. We were back to about 60% of original business. OPDs again were back to about 75 to 80% of their pre-COVID levels, simply because people were still a little apprehensive about going to crowded spaces. And then towards the end of March, we saw COVID come in, sort of hit us again. So that's where we were as far as Q4 is concerned. But we're very proud of our performance in this quarter. It's the highest ever EBITDA. Our revenues, over Q3 were flat. But our cost saving initiatives of about 108 odd crores that we've done, through the course of the year, entirely came to bear in the last quarter. So that is one of the reasons that you see very high sort of ARPOBs. ARPOBs moved from 53,000 to about 57,000 in the fourth quarter, and the margins improved from 23.2% in Q3 to 24.1%. So our EBITDA moved from 250 odd crores to 263 crores.
Right. So when I talk to some of your investors in the company, they say that Abhay Soi is a man who is known for execution, who is known for cost saving. And with the merger and the new acquisitions that they have done, cost savings will come in. As you pointed out that margins are at the highest, you think the best of the cost saving is achieved, or because of COVID-related products or the problems that various healthcare companies are facing in, some of the margin benefit may actually be visible going ahead?
So I think only one of the drivers of the margins essentially is cost-saving initiatives. A bigger driver of margins is going to be revenue and increase in revenue, and that has because your fixed costs, which is majority of your costs in hospital sector, is not going to be linear along with the revenues. What we've seen is, like I mentioned, international business is yet to come back. That is something to look forward to. The regular OPD business is something to come back, in its entirety. In addition to this, there's been a huge proliferation of insurance. So what we are seeing is insurance patient, PPA patients, etc. That segment of our patients have been sort of growing at an extraneous pace, and so that is something. All of it will lead to perhaps further increase in margins. So I don't think the story stops here. We are focusing on revenue. Whilst we've been dealing with pandemic, we've dealt with the merger, we've dealt with the listing, we've dealt with the QIP over the last 12 months. We've also been working and putting our building blocks in place, particularly with respect to international business. We've now set up a subsidiary in Dubai, which is going to be our direct to fly. It's going to be covering the Middle Eastern markets. We're going to have offices all over the world, African cluster, Middle Eastern cluster, and so on to drive this traffic for us. So we feel quite good about the coming quarters. We feel quite good about the business going forward. So yes, I don't think the story is going to stop at these sort of margins alone.
Right. So, we spoke quite a lot as far as 2018 is concerned when you were trying to bid for Fortis assets. And that time you very clearly specified that hospital industry is in a phase of consolidation. After that, of course, we've seen your M&A, we've seen Fortis being acquired by a global player. Some of the other smaller players, especially in the diagnostic space, have gone ahead and sold out to the big ones. You think that consolidation phase is over, and people who wanted to attain size have actually gone ahead and done that in the industry?
Certainly not. I think, in fact, COVID perhaps hasn't been kind to everybody. Some of the balance sheets will be challenged. There will be others who will be looking at, because, there's been a sort of, in the industry, there's been, now you have some of the larger players, and then you have a lot of fragmented smaller players. So consolidation is going to be the key going forward as well. And I I think there are going to be tremendous opportunities once the dust settles. Unfortunately, I mean, we would have embarked upon further acquisitions, in the past year or two, but unfortunately, with the whole COVID situation, we were dealing with this. But I think we'll be getting back to looking at opportunities going forward.
I think you should take conversation with Pankaj with the management of Max Healthcare. But on that note, we'll slip into a break on this edition of Buy Now, Sell Now. Stay tuned. Don't go anywhere.
Welcome back. You're watching Buy Now, Sell Now. Now, over the past 5 minutes or so, you've seen a weakening of the trade sentiment. As of now, in the Indian equity markets, you have the Nifty 50 that's currently trading in the red, 30 points or so lower. And the broad market breadth is also now significantly in favor of the declines. Perhaps the reason why that is because Moody's has come out and trimmed its estimates for FY22 GDP growth for India. Ruchi Bhatia is joining in on the phone line with more details. Ruchi, what exactly is Moody's saying?
Well, in fact, rating agency Moody's is saying exactly what we have been hearing from other rating agencies in the last couple of days. They have said that the second wave of COVID-19 will hit the Indian economy hard. So much so they have trimmed their forecast from 13.7% for FY22 to 9.3%. They also have said that the second wave of COVID-19 will have long-term credit implications as well, and that could threaten India's economic outlook. They have said that India's economic recovery is all set to be protracted. It could be incomplete, and they are expecting a small shortfall in terms of the revenue projections on for the government in FY22, and which is why they have said that there is a possibility that the general fiscal gap for FY22 could be as much as 11.8%. They have said that that India's fiscal position is likely to be in a tough position going forward. They also have said that structural inefficiencies will continue to constrain India's growth potential and will limit the resilience to shocks as well. They have also reiterated that India's debt to GDP is all set to edge up to 92% by fiscal year 2023, and this is largely going to be driven by slow economic growth. They also have highlighted, in fact, that there will be a lot of risks for India's financial sector that could be the main driver for a potential event risk to India's sovereign, which is why they have said that the second wave of COVID-19 will increase the financial risk to households and small businesses, and that is set to hurt the Indian financial sector's profitability as well. So very important commentary coming in by Moody's. The critical one, of course, is that this is coming right after we have seen, yesterday's GDP as well, and now Moody's trimming the forecast despite Finance Ministry putting up a very brave front saying that the second wave will not have much of an impact. It's clearly opposite to what the rating agencies believe so far.
Definitely. Thank you, Ruchi, for taking us through that important update coming in on Moody's slashing the FY22 GDP forecast for India. But let's move on. Let's get on board our guests for today. We have Kunal Bothra as well as Rajesh Agarwal joining us. Good morning, gentlemen, and thank you for waiting by. Let's quickly start up with our query segment then. And the first query is a Twitter query that we've got from Mr. N. Chandrasekaran. And he's saying that he's holding on to 2,000 shares of Thomas Cook, which he bought at an average price of 65 rupees per share. And he's been holding it for the past 2 years. He wants to know whether he can hold on to the stock for one more year. Wants to know what sort of an outlook should he aim at, and also what sort of target should he look at for Thomas Cook over the next 1 year. Rajesh, good morning, and I'll pose this question to you. What's your outlook on Thomas Cook? Definitely, you've had the entire hospitality and travel and tourism sector be impacted with COVID-19 over the last 1.5 years. But how's the outlook looking for Thomas Cook? Can Mr. N. Chandrasekaran hold on to this particular counter for the next 1 year?
Morning, Alex. You said it right. The hospitality industry has been affected very severely. In fact, it was one of the industry which has been severely to the highest affected industry, I would say. And there are no hopes that in the next 1 year or so things would be coming back to normal that was pre-COVID area. So I don't think there is any reason to believe that the stock is going to perform in the next 1 year or so. So unless the gentleman is ready to hold on for a longer period of time, I don't find any reason to be in the stock. Maybe one can switch to other sectors which are doing well. In the long term, yes, of course, we all have hopes that after the vaccination drives and on, these things would improve. So if he is a long-term investor, one can hold, but for the short term, I would say one should switch.
Okay, that's the word coming in on Thomas Cook. Unfortunate dip last year, if I'm not mistaken, when the international entity had problems. Now, we've got the first question on YouTube coming in from Satish, and this one's for you, Kunal. Good morning to you as well. This is on Sharda Cropchem. The question is, would you buy for 1 to 2 years as of now?
Alex, yeah, I think it's a good chart. Last 1 year seen a good recovery from 100 odd levels where it started off from the March 2020 lows. It's done reasonably well, rising up to almost 3.5 times from those levels. So longer term charts, are into a recovery mode, and the short term charts are also quite buoyant for Sharda Crop. I'm not sure of the liquidity of this name because I don't track the stock that often. So you just have to delve more deep into the liquidity aspect over here. But nevertheless, the charts are quite okay for Sharda Crop. And if you're looking to buy, I think current levels is where you can look to start average. And if the market gets into a bit more volatile zone, then I believe any kind of dips which comes by, for example, the stock comes by to say 320, 325 mark, that should be another good level where you can look to average further.
All right. Our next viewer query is coming from the handle name as JML Motors. Next time I would request you to put in your name as well. His query is that he wants to know about RSWM and VA Tech Vabag companies. He wants to know whether are these the good companies to actually invest in, and if so, what sort of target should one look at for these companies? Rajesh, I come to you with this question. How is RSWM and VA Tech Vabag? How are these companies placed? It makes sense to invest in both of these companies?
See, if it's a long-term investor, yes, it's a very good company. I would say it's into textile and some subsidiary as power also. It's a Rajasthan-based company. They're into spinning and weaving, and with the kind of activity we are witnessing at this point of time in textile sector as such, and some sort of PLI also being expected in this sector, I think this is going to perform well. Valuations are also very attractive. So if somebody has a long-term view, by long-term I mean 12 to 18 months, one can definitely buy.
Okay, we've got a question coming in from Balakrishnan on SBI. Bala, you've asked several questions, but I'm going to take your question on SBI. You've asked about Tata Motors and ITC as well, but let's see if we have time for that. We've got a view that is being asked, Kunal, for 1 year, and the stock is trading at a record high as we speak, right? Is there significant room? A lot of people have pointed to fundamentals being better than its peers, and therefore the need perhaps for a re-rating, but how is it looking on the charts?
It looks very attractive. In fact, SBI has been one of the top performing PSU banking stocks in the last 1.5 odd year. More importantly, the stock has got back its leadership quality. So, these are all classic ingredients which you look out for in large cap names and most solid stocks as well, where they have, leadership quality, where the price performance is quite strong, and where these stocks, they manage to, lead the breakout and give direction to the entire sector. So SBI seems to have shown all of those characteristics. So if you're bullish on the markets, then I think SBI, of course, has to be one of the top picks in the banking space from that aspect. And you can also look at maybe an ICICI Bank as well from the private sector bank. So bullish on SBI, and I think may not be exactly 1 year, but I think over the next 1 to 2 years, I would look at even a potential 500 to 550 as a potential target range for the stock.
The next query is from Ritesh Garg. He's saying he has Reliance Industries June 2200 call. He's getting 45% return. He wants to know whether should he hold it until Reliance goes to 2300 or should he go ahead and book profits. Kunal, what should Ritesh do with Reliance June 2200 call?
I think it's a tough one, frankly, because I'm bullish on the stock, but at the same time, when you look at the last 3 days or 4 days of price movement, Reliance has run up quite strongly from 1950 levels. In just a matter of 3-4 days, the stock has jumped up to 2200. So the question is, positionally, yes, bullish, but the question is that whether the stock consolidates over here for some more time, then your call option, you may lose out. You may start losing out the time value on the call option. So that could be a bit tricky. I would suggest that book out profits over here for Reliance Industries, and then watch the stock for some more correction if it happens along the way. Say over the next a couple of days, over the next 1 week, if the stock consolidates and if you get the stock say somewhere closer to 2150 levels again, then I think it could be a good level for you to buy back the call option again. So I would suggest to book profits as of now.
Okay, Rajesh, coming to you on a long-term query, we've got Raghu who's holding HDFC Life 50 shares at an average cost of 614 rupees per share. Raghu wants to add further for the long term and is wondering whether to continue to add or should he look at another stock?
See, for a long-term view, I would say, Alex, this entire insurance pack is going to do well, whether it's HDFC Life or SBI Life or ICICI Pru, Lombard. I think that the entire insurance pack is going to do very well, one, because of the increased education about insurance, which people are having. The ongoing COVID process has again given a impetus to this industry. And not to forget the value of new business, at least HDFC Life has garnered. They are more into digital, and the spend they have made into digital is going to give good returns in the long term. I think it's a very good choice. And for long term, maybe 18 months, 24 months, this stock can move up from 20-25% easily from the current market price. So I would say, yes, of course, one can buy.
All right, the next query is coming in from Pavan Kumar. He wants to know whether he can buy ONGC June 120 call. Will the rally continue as it's on verge of breaking its resistance? Is the word is what Pavan wants to know, Kunal. So can he buy ONGC June 120 call?
Well, it'll be a bit of a touch and go because the stock is nearing that breakout. In fact, 120 is the resistance for ONGC on the short-term, medium-term chart. So we can anticipate a breakout, but then I would suggest that maybe wait for another couple of points, let the stock get back this momentum, and let's see whether the gains which or the breakout which the stock is showing today sustains for the remainder part of the day. If that happens, then I believe buying an at-the-money call option for ONGC at 120 strike could be a good strategy. So it's a good wait and watch approach as of now. Until the end of the day, if the stock manages to sustain this rally 3.5% and slightly gain beyond this as well, then I believe you should look to you can probably anticipate the breakout and then look to buy the call option.
Okay, we've got Neeraj who's asked a question on central depository receipts, CDSL, Central Depository Services. And the question is on the long-term prospects of this counter. What would you say, Rajesh, would that be? He's bought at levels of 880. This is now he's looking to hold for 2 to 3 years.
Yeah, like there are basically two players in the depository segment. One is NSDL and the other one is CDSL. So NSDL is unlisted, and if somebody wants to take an exposure on the broking business as such, CDSL is the only choice. Valuation wise, it's very good, debt-free company. It's doing very well. The number of additions in demat accounts has been very encouraging in the last 1 year or so. But I would like to add one more thing into this, because BSE Limited is holding 20% of CDSL, and the valuation of which is almost 2,000 odd rupees. And the entire market cap of BSE is 4,000 odd crore rupees. Not to forget, BSE is holding around 600 odd crore rupees in its balance sheet. So I would say if somebody wants to take an exposure in CDSL, because of the kind of run-up it has taken in the recent past, I would say BSE would be a safe bet where you have an exposure to an exchange and even to CDSL.
Right, our next query is come from Sagar. Sagar is one of our regular viewers, and before I go on to his queries, Kunal, Sagar actually wants to thank you for your view on Heidelberg Cement yesterday. He definitely benefited from that particular view on this cement company. His query today is that he wants a view on Aeon exchanges. He's bought 100 shares at 999 rupees per share. He wants to know whether he should continue to hold on to the stock or go ahead and book profits.
I think it's an interesting name, Aeon Exchange. I think it's not a stock, frankly, which I track that often. But then the charts for Aeon Exchange, I was just looking at the stock, over the last 12 months to over the last 4-5 years. I think it's done phenomenally well and risen up, to almost 4x or 5x from its 2015-16 lows. So I think in that aspect, it gives off a stock which looks quite strong on the long-term charts. And if you bought at lower levels, then I believe that you can continue to hold on. The stock doesn't show, those kind of extreme volatility. I think the best which the stock has gone through in terms of a corrective phase was in 2018-19 as such. So I think it seems to be a good enough chart to hold on from a longer-term perspective.
Okay, I'm just taking a chance on this one, Rajesh. Do you have a view on RPSG Ventures? We've got Pranav Dangi, who's bought at levels of 400, and he's asking about the long-term prospects.
The long-term prospects of this company is very bright. The valuations at which this is trading at this point of time is a very low percentage of the actual valuation, I would say. They have the entire gamut of financial services into that. They are moving into their holdings into different companies like FSL. They have a whole mall in that, property businesses there. They have launched some chips type of snacks business into that. I think there is a lot of value in that one. Would be better hold for a longer haul of time. But the only problem with this counter is it's a low liquidity stock, but for a long-term investor, liquidity doesn't matter as such. And I won't be surprised if from the current market prices move by 50-60% in the next 1 year or so if this pandemic thing goes out. This is the only risk which I find in this stock.
The next queries come from Sherry and wants to know that can she put 10% of her capital in India Bulls Housing as it's done deal with HDFC recently in April 2021, but she's definitely afraid of it because considering the news flow that has been surrounding that particular counter for a while. So Rajesh, is it prudent to actually allocate 10% of her capital to India Bulls Housing Finance, and if not, which other stock would make sense?
The fact that India Bull Housing Finance has seen a lot of restructuring in the recent past, the promoters being changed and all those things, but still I would prefer going with larger names like HDFC Limited or LIC Housing Finance, which gives good dividend and has a backing of LIC, rather than going with India Bulls Housing. Even a Canfin Homes is a better bet. So I would say instead of buying India Bulls Housing, you can take a pick from any of these three, HDFC on the largest side, LIC in the medium side, and Can Bank in the smaller size. Canfin, I'm sorry.
All right, we've got Shashrut, who's looking for the short-term prospects of ONGC. It was looking strong just a short while back, Kunal. What would you recommend that Shashrut do in the short term with regard to ONGC?
I think it's a good chart. We were discussing this earlier as well, that how 120 is a resistance point for ONGC. And I would sense that if that 120 level gets taken out, that is where a bigger breakout for ONGC could probably happen, and this could be at least a 15 to 20% breakout, and it's a big breakout, frankly, for a stock like ONGC, which is a very, or typically a very low beta stock in that sense. So I would suggest that you wait and watch. let that 120 level get be breached or be taken out. I think if that happens, then I think it makes a good sense to try and buy, because then you could be buying at a breakout point where there could be a very strong surge of momentum. Otherwise, what the stock can do is it can just about continue to remain in the range around this 110, 115 on the lower side to 120 on the upper side for some more time. So I think time is the important element over here. And if you're looking to time it properly, then I believe wait for a breakout about that 120 mark.
All right, the next query is coming in from KR Balan, wants to know about Burger King. He has 300 shares which he's purchased at 145 rupees per share. He wants to know what should he actually do with Burger King, hold, sell or switch. Kunal, what's your take on Burger King?
Hold, in fact, I believe that even though the chart history is very limited, but I believe that on the very short term aspect, the last 1 week, 2 weeks, the stock has seen some incremental or increase in volumes. And I think that's a very encouraging sign for a stock like Burger King. So I think in that aspect, I would suggest that you can hold on to your investments over here. Let the previous resistance, a swing high of 159, 160 get taken out. If that high is taken out, then you could be looking at a possibility of the stock coming back towards that 200 levels as well. So it's a good anticipation trade. The stock is at 147 levels. Would hope for a breakout pretty soon about that 160 mark, and that breakout could probably lead to at least another 30 to 40 points on the upside for the stock.
All right, the next question is coming in from Pooja. Pooja has bought HCL Tech at levels of 951 and is intending to hold for the long term. Rajesh, is that a good idea, or would you suggest shifting to another IT company?
Is a good bet, I would say. Yes, of course, there are other companies also which are doing very well, like the likes of Infosys or Wipro. But HCL Tech is also not bad. One can continue to hold the numbers. They've been pretty good. They have good number of clients and the kind of management commentary which we have seen in the last quarter results gives hope that the company is going to do well. So there is no second thoughts that this company is going to give good returns in the next 1 year or so. Definitely one can go ahead.
All right, our next query is coming in from Padma. She's bought 200 shares of Mahindra Lifespace. She's bought them at 520 rupees per share. Wants to know whether she should continue to hold on to the stock over the longer term or consider switching to another counter. Rajesh, what's your take coming in on Mahindra Lifespace? Makes sense to continue to hold on to the counter?
We discussed that the entire hospitality sector is in a problem. So it's no point holding into the stock at this point of time. If somebody wants to be in a hospitality sector, the likes of Indian hotels or East India hotels are good because they are on a very low valuation. And if one wants to hold for 2-3 years, that's a better bet. But still, I would say it's no point sticking to these stocks at this point of time. It's better to switch to either cement or infrastructure. Even PSU banking space is looking very good.
I'm going to ask you to give a quick view on this one. Manjunath has got 100 shares of GIC Re at an average price of 415 and is therefore losing quite a bit on their investment. The question is, should they shift out to SBI Life? I know it's a completely different sector, but would you suggest that shift or another stock that you would recommend?
Is it for me?
Yes, Rajesh, for you.
Yeah. See, one can definitely hold on to GIC Re because in reinsurance business is the only listed player, but SBI Life would be a better bet because it's a direct play into insurance. And as we discussed some time back, that insurance sector is going to outperform in the next 1 year or so. I would say one can definitely go ahead with SBI Life if one has to take a choice between the two.
All right, the next query that we have is from Shanti in the view of wants to know about Goodyear. saying that in the view of FY 2021 was good. Is it good to go ahead and buy Goodyear at current market price with a target of around 1,175 rupees per share? Wants to know what's the take on Goodyear over the medium to long term. Rajesh, what's your take on Goodyear?
Not only on Goodyear, but the entire tire space as such. Goodyear being an MNC company, they have recently announced very good dividend. The numbers have been good. I think it's going to outperform. It has not performed at all when you compare to the likes of CEAT or JK Tyre or Balkrishna Industries. It has not performed. It will perform well. It is a catch-up game which will take place. The only issue is with the volume. So if one is a long-term investor, definitely one can buy this stock.
Yeah. All right, let's quickly go to the high risk and low risk segment. I think a lot of viewers are also interested in that. Kunal, starting with you, what are the ideas that you have for us today?
First one is about Coal India, expecting the stock to break out pretty soon. We've seen many strengths from many PSU stocks, so I'm expecting Coal India to break out soon on the upside. So would suggest a buy with 160, 165 as a target, and stop loss to be kept at 143. And the second would be a buy on Reliance Industries, expecting the stock to do pretty well for itself over the near term. Maybe the stock may consolidate for a couple of days, but then I believe that with the recent breakout, the trend seems to be very strong on the upside for Reliance Industries in the near term. So buy with a target of 2,250 and stop us at 21.35.
All right, Rajesh, what are your high risk and low risk ideas for the viewers today?
I would go with the cement company, that's Dalmia Bharat, with a target of 1,900 odd rupees in the next 9 to 12 months. They have reported a strong set of numbers. The takeover of Mulli Industries is going to help in near future. They have plans to double capacity in the next 3 years. For the time being, the capacity has been slowed down because of pandemic, but ultimately that's going to happen. Focus on debt reduction is there. The balance sheet is very strong. And the best part is the Eastern India market is doing very well, where the price rise has taken place for around 20% odd. So I think this company is going to do very well. For medium-term target, one can have a target of 1,900 odd rupees. The other one would be UPL. That's a strong play on agro industry as such. The numbers were very strong. The margin has expanded. Debt they need to reduce, but the company has focused on debt reduction also. Strong crop prices, MSP hikes, these are going to do well. Even the Agastya acquisition which they have made would add to the numbers. And the Latin American market is doing very well. The target is 925 rupees in the next 6 to 9 months.
All right, thank you Kunal as well as Rajesh for joining us on ET Now and resolving viewer queries, also giving your high risk and low risk ideas for our viewers. All right, but on that note, we slip into a break in this edition of Buy Now, Sell Now, but stay tuned, more on the other side, so don't go anywhere.
Welcome back. You're watching Buy Now, Sell Now. It's time to talk to Indian Bank. It posted its earnings for the fourth quarter, and it's seen a deterioration in its asset quality, but all things considered, it has been a reasonably good quarter for the bank. It's back in the black. We're joined, in fact, by the Managing Director and Chief Executive Officer, Padmaja Chundaru. Thank you so much, ma'am, for joining in. The bank, all things considered, posted a resilient performance on the asset quality front in a COVID pandemic year. What has led to the performance that we're seeing on the slippages ratio for FY21, which has actually shown an improvement of about 300 basis points?
Thank you very much. I think this year has been very challenging and also very satisfying. It was challenging because the bank was going through the amalgamation process also, and there was all this COVID atmosphere around. There was a lot of uncertainty both in terms of business and the outcomes of the amalgamation. I think that was weighing down on the bank's stock price as well. I think the first year of amalgamation has set at rest all the apprehensions about the outcomes. The bank has emerged very strong and also has a very solid foundation for future growth as well. There is good visibility about the future now, much more certainty. Yes, there is the issue of and the apprehension around how the COVID situation would play out. But if you see the key ratios, whether it is the capital adequacy, the asset quality, even in terms of the cost to income ratio and the earnings, I think everywhere the bank has proved that it is now in a very strong position to meet any headwinds. Also, it's poised for a good growth in the coming years once this environment eases. Yeah, thank you.
Ma'am, the COVID-19 second wave has been quite damaging. It has impacted apparently rural India too this time around as opposed to the first wave. What is the impact that you're seeing across segments and categories and across states? What are the trends that you're witnessing with regard to collection efficiency and delinquencies?
True, the second wave has been a bit, more. I think the volatility in the various sectors is much more during the second wave. Also, the banks have been impacted in terms of the lockdowns in various states at various stages, in terms of our own working and in terms of our own people getting impacted. So there is definitely a lot of pressure on that count. When we come to the sectors, yes, corporate I think is still able to withstand, and we don't see too many delinquencies or much concern there, apart from what we already know and what is already there on the books to some extent. In terms of the MSME, yes, that is the most vulnerable sector as ever. And the issue is there about the opening of and the working of the units. But I think with the kind of restructuring and also the ECGLS scheme that was rolled out last year and the steps that the bank has taken towards giving succor to the MSME sector. This year also there is the RBI guidelines that have been rolled out, as well as the government extending the ECGLS scheme and extending it to the hospital sector, the healthcare sector. I think this would help a long way for the bank also to reach out to the customers and actually help in avoiding much friction or much slippages there. That said, I think MSME slippages would still be a notch higher than last year. Then we come to the agriculture sector. I think that is more or less still holding up in terms of both the crop loans or the other kind of KCC or other investment credit that we have given. And it also helps that after amalgamation, this bank is now a pan-India. So the asset diversification, both in terms of the geography as well as the sectors, I think it works well for the bank. Retail continues to perform. Our loans are again mostly to the salaried people and mostly to the secured housing loans, etc. So in terms of restructuring that was recently announced, I think it would be more in the MSME sector, and we would end to some extent retail. So I believe that would help us ride the second COVID wave again in a much better way. Thank you.
Good morning, Ms. Padmaja. This is Cheryl also joining in the conversation. Let's talk about the asset quality, and given the backdrop of COVID-19 second wave, do you see your gross NPAs actually rising much higher than 9.8% that was reported in Q4? Also, do you think that the second wave of COVID-19, because of that, your FY22 will see higher provisions or credit costs versus FY21? And also, would you be further looking to enhance your provision cover from current 82%?
So on a quarterly basis, yes, June quarter is going to be under, some kind of a cloud. I think that would work. That would be because more than half the quarter is over, almost 2/3. And still the collection efficiency has not really improved. It was very good until March, and to some extent April was okay. But again, April end and May, the collection efficiency has come down across the various segments in the bank. So we expect that June would be a little difficult. But again, given the restructuring that is announced and the bank has reached out to all the customers, we have already rolled out new products as well as the the templated version for the less than 10 lakhs, which IBA has announced recently. Even for the more than 10 lakhs, we have already sent SMSs and connecting with the borrowers to get them invoked, the restructuring. So I think that we will be able to contain the slippages in June and more so in September, in fact, in the year forward. I don't see any, today, I think things are under control, and whatever projections we have made and whatever scenarios we have built, the credit cost should be below 2, and we should be able to maintain that even during the current year.
All right, then let's talk about recoveries. What kind of recoveries are you looking at going ahead?
Last year, the recovery was more than 4,500 crores, which was the target. In fact, another 600 or 700 crores was upgraded also. This year, I think we would be targeting about not less than 5,000 crores recovery, both from NCLT and outside NCLT recoveries that happen either through direct recovery, cash recovery, or OTS. All other tools are at play, and I think we will be able to achieve more than 5,000 crores.
The RBI policy is later this week. What are the expectations that you have from the RBI's Monetary Policy Committee, and also what measures do you think are required for the RBI and the government to put in place to bolster the economy?
I think both RBI and government have been stepping in as the scenario unfolds, as we have seen last year also and this year so far. So my expectation is that the rates would remain, at this level. I don't think the rate would go up in the short term. And I also expect that when the situation demands, both the government and RBI would step in with more such measures. Whether it is the extension of these schemes we have to really wait and see how this restructuring especially pans out, because the invocation time is up to September and then the implementation up to December. I think that is a very good timeline to actually judge the performance. By June end, we should know how these initiatives are taking off. And from the government side also, they have already extended the ECGLS scheme for up to 2 crores. For oxygen manufacturers and also healthcare sector. The bank itself has again given targets out for this building the COVID portfolio. I think these are all good measures and which will play out in this year. And I am sanguine that both RBI and government are looking at the situation and are very frequently interacting with the banks and taking our feedback also. So that should be it is a very good confidence building measure for the banks.
Well, credit growth has been muted in the last financial year for all players, and we've had a rough start to the current year as well. What kind of credit growth are you expecting for the current financial year? And also, what are your capital raising plans via equity or QIP or even 81 bonds?
So the credit growth, yes, corporate credit growth was very muted. It was almost a plateau in the bank. Of course, part of it has gone into the investment portfolio in the TLTRO and all those, bonds investments. Taken that, the corporate growth book would be about 4 to 5%. But that said, the retail agriculture MSME portfolio grew last year. It grew by 12% in Indian Bank, and especially MSME, I think, grew by 15%. This was partly due to the new lending under the ECGLS scheme. Apart from other lending by the bank. So I still feel that the RAM sector would continue to pick up after this initial lull of after June. And when it comes to the corporate also this year, I expect that the corporate demand would pick up. The utilization of limits has been subdued in this last financial year. And there is now, I believe, a pent-up investment from the private sector that has to come up. And that, complemented by the lending from the banks, I think Indian Bank is well poised to take higher exposures on corporates, well-rated, well-managed corporates. We have already done that last year. And this year, the bank is very well poised, both in terms of the balance sheet size, the capital availability, the risk appetite. I expect that growth would be more than 12%. And so overall, the book should grow between 10 to 12%. And when it comes to capital raising, I think if you see the capital adequacy ratio at 15.71% for the financial year, that's a very strong support for growth for the bank, for both whether it's growth capital or risk capital. We have played out various scenarios of the COVID second wave, and we find that capital is probably sufficient. Only how the worst case scenario plays out, we need to look at. But that said, I think there is really an opinion in the bank that we need to take the market, advantage of the present situation in the market, and wherever it suits our expectations and where the price is reasonable, we will go for a QIP. We have a board approval for 4,000 crores for the capital raising. During the last year, we had raised 4,000 crores tier 1 and tier 2 bonds at very reasonable rates, and also redeemed about 500 crores, which was at a high rate. So this exercise is going on, and we'll take a call depending on the market situation. Thank you.
All right, Ms. Padmaja, we leave it at there. Thank you for joining us on ET Now, giving us a look of how Indian Bank has performed in the quarter gone by and what to expect in the year ahead as well. All right, on that note, we are out of time on this edition of Buy Now, Sell Now. From Alex and myself, thank you for watching. Stay tuned. Markets at noon coming up next.